China a buy, or is it too late or too risky? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Rupert Mitchell, author of the Blind Squirrel Substack. Hi, Rupert. It's great to have you on again.
Hi, Maggie. Happy Patrick's Day.
It is indeed, and I'm not even wearing green. We did have a little green on the screen, though, so maybe we'll take that. A bit of a reprieve today after a painful 4-week sell-off. U.S. stocks bounced back. All the indices were up about 1%, certainly on the S&P and Russell. But really interestingly, we were just talking right before we came on, and those gains sort of faded into the close, especially if you looked at the NASDAQ. The index itself stayed in positive territory, but only about a third. We had some tepid retail sales. Initially, people were relieved it wasn't worse, but it seems like there's still some angst out there. I don't know. If we pull the lens back, does it feel like the equity correction is starting to sort of exhaust itself or run its course, or are you skeptical about this bounce?
Well, I think it's got further to go, to be honest. It's not uncommon to see sort of, painful and face-ripping rallies in a broader sort of downward trend, and we've had one of those in the last couple of days. I think it is interesting to see that before I jumped on, 4 of the 7 Mag 7 stocks were in the red as we went into the close, and I think that those large cap US tech stocks are just operating as an ATM for asset allocators around the world right now. And US equities have been such a great trade for such a long period of time. Allocators have got themselves massively overweight over the years, and we're just seeing, we've seen almost 3 months of a reversal of that flow, and I think it's got further to go.
Yeah. It's interesting. The FT posed a question recently: is America's bubble bursting? Not just tech, but America's bubble bursting. And one of the articles said the U.S. is overowned, overvalued, and overhyped. That's pretty aggressive language, pretty provocative, but it does call into question this whether this is the beginning of a much bigger trend, or is it just that things got a little bit overboard? Like, what is the extent of the rebalance, I guess, is what I'm asking. Does it feel like this is going to be significant, or, are we in this period now? It's sort of what everyone's talking about, but it's not going to be sort of this seismic shift.
Yeah, I mean, the throwaway phrase sort of valuations don't matter is absolutely true when momentum trade is working in your direction. After 3 months, it's now pretty clear that momentum trade is no longer working, at which point valuation does matter. And if you're a global allocator and you're underweight your home markets, you're underweight the rest of the world, you've now got to, you've got to justify to your community why you are still in a momentum trade that is no longer working. And I think that's where we are right now. Home markets, which they are underweight, are significantly cheaper and are working. The momentum trade is elsewhere. The momentum trade is in Asia. The momentum trade is in Europe right now, and they're cheap.
I think that is such an important distinction, and I was just, for those of you who haven't seen, we have an interview with Harris Kupperman, Cuppy, on, and he was saying something similar, Rupert, that it is, if you are a money manager and you are behind, you are in trouble, right? You have to catch up. But I like your distinction because it puts it in the frame of momentum, because you can talk to someone and they'll give you a million reasons why, say, Germany may have some issues ahead, or, it's not 100% clear, wave the green flag, bull case when you talk about the fundamentals for some places, right? There are plenty of arguments why it's risky, or there may be, turbulence ahead in those international markets as well. But you really put your finger on it when you were talking about it through a momentum lens. And I think that's really important. And that explains a lot of the pushback I get when I ask people about this reallocation.
Yeah, I mean, listen, people that think and write about markets a lot, tend to lean towards mean reversion and fundamental analysis, right? Because that's the way the books were written. But a dirty little piece of history is that if you I mean, AQR have done this work looking at factor strategies over, decades, and you've got three types of trades in the world. You've got momentum trades, you've got carry trades, and you've got mean reversion trades. Now, mean reversion is the sort of fundamental analysis trade. Carry trades are what very wealthy institutions do, picking pennies up in front of steamrollers. I mean, essentially, it's a short volatility trade. But momentum, which is buying the stuff that's going up and selling the stuff that's going down, has outperformed all other factors over the years. We're all human beings, and we like to herd, and we like to follow things that are working. And you've got to recognize that when the regime has shifted. And you're right, I can think of a million reasons why you could be bearish about the economic fundamentals of Europe and the UK, but it's going up, right? And you know what? It's got the backing of the fundamentals as well. So you don't look like an idiot necessarily if you get it wrong. But you've got a green light to follow the momentum. And same story in China. I mean, this is the bull market everyone's been willfully ignoring for the last 2 years now. Ultimately, at some stage, the allocators go no mas. I've got to be in the trades that are working.
Hi, everybody in the chat. It's good to see you. So, Rupert, against that backdrop, first of all, when we're talking about time frame, momentum trades makes me think a little bit shorter term, but can they last? Can they last a long time? Can they be significant? I guess you could argue the U.S. has been in a momentum.
Mag 7's just coming to, arguably, I think, coming to the end of a 15-year momentum trade, right? So, yeah, sure. When trends can extend for a long period of time.
Yeah.
Right. And if you want to put a sort of a mean reversion framework about it, ultimately, if you look at what's underpinning the outperformance of US tech over the last 18 months, it's based on an AI narrative, which frankly has been sort of held beneath the waterline in the last few months. We've got this CoreWeave IPO coming up right now, which, as a former capital markets banker, I'd be utterly terrified of leading that deal right now. It's got more red flags than a Chinese bazaar, but that thing could well end up sort of becoming emblematic of this turn in trends.
It's so wild because I just, as everyone knows, I was out of pocket and last week, and I was at a conference with procurement leaders, all the people in charge of sourcing and supply chains, and I thought we were going to be talking about tariffs the whole time and what that's doing to supply chains and the concerns, and instead, a lot of it was about AI and how far along they are and what they are doing in terms of optimizing AI. And it was really interesting. Like, no one's told them the AI bubble's over, but I suppose that at the use of it, it's the capital spend on the large language models that we're questioning.
That's exactly what I'm talking about. I'm a frenetic user of AI tools these days. I mean, and my only concern is if the likes of Perplexity actually charge me properly for my use of it, I probably wouldn't be able to afford it. So it's actually, there's a massive subsidization of the rest of the world going on by large cap tech, and the markets have been behaving as though these guys are all creating valuable monopoly profits in the future. But I don't believe that's the case anymore. There is no moat.
There is no moat. Yeah, that's
capital alone. The idea that just spending trillions of dollars on these AI data centers was going to create a monopolistic moat for them, it's just been disproven now.
Mm. Mm. So if the flows are leaving and look like they're going to continue leaving the US, which by the way, it's so interesting. I love talking to people sitting elsewhere, in your case, Australia, because I feel like it feels different depending on where you are. And I think that there is an enormous amount of skepticism and maybe denial about the extent to which this will continue. We're certainly talking about it, but if you just sort of throw on the regular financial news or, talk to people in the US, I don't think there's a sense of this yet. But what's the beneficiary? Has it largely been China, or do you feel like China, Germany, is it pretty concentrated in those two markets, or is it spread around?
No, I think it's. I mean, I one of the first chart that I look at in the morning every day is actually not emerging market related. It's the SPY, the S&P 500 versus the MSCI EFA, which is the global developed markets ex-US. And I mean, it's a chart that I've been putting in my notes literally every week for about 3-4 weeks, and there's been a massive trend shift that kicked off basically in the dying days of 2024, and emerging markets have been a beneficiary as well. I'm really, I mean, it's tough. It's tough until the formal numbers come out. But this does feel like sort of trading flows only that it's coming into China. The flows into Europe are much more meaningful, and they're going in through a very narrow door. So it's having some sort of spectacular sort of parabolic effect on less liquid European markets. But the flows going back to Europe are largely, I think, European money that's coming home, right? It's a similar story, I think, when you think about China. Right now, I don't see big US allocators moving lots of dollars back into Chinese equities, but I see a lot of Chinese capital that was sitting and hanging out offshore that's coming back in. And the traders. I wonder how long. I wonder when people will stop talking about Chinese equities. This is a rentable, tradable rally. I think ultimately there's that narrative is going to have to stop, and meaningful allocation is going to have to come back in.
Well, that's interesting though. But Xi's crackdown on tech and tech executives and everything that happened in that period really put a chill on attitudes toward what investing in China means. And there are some people who think it's not investable, who think that you are not, at least in the way that it was before. A proxy, yes, but directly into China, those voices are still pretty loud, and that fear about it being a different model. Do you think that that is just misunderstanding the situation, or do you think that there is something to that?
Well, I mean, it's very clear that the narrative on Jack Ma's disappearance has been reversed this year. I mean, he was that was a very significant appearance in that gathering of tech leaders the other day. And I think we're in a very different world with respect to how Xi and the Communist Party views the equity market right now. We've talked for years about a Fed put in US equities. You got a Xi put underneath the Chinese equity market right now. He wants that market to work. He wants Chinese savings to be diversifying into Chinese equities. The CCP's got your back in Chinese equities.
If you're Chinese, but foreign investment?
I think it's much more likely that international investors would be penalized for investing in China by their own authorities rather than by the Chinese authorities. And we've already seen that with the American First investment policy. Could the Trump administration make it very difficult for American investors to invest in Chinese equities? Yeah, absolutely. And they've already announced their intention to do that. But are investors going to lose money because of something that Xi did? I don't think so.
Interesting. Is there increased confidence? So he wants the equity market to do well. The authorities are leaning in that. What about attempts to revive the economy? Do they seem to be taking hold now and resolving some of that sort of
We had some big announcements. Firstly, we had the NPC at the beginning of March, and then we had some big announcements around measures to improve consumption activity in China over the weekend. And this is big stuff. There's there's a massive there's a constant sort of theme of they never announce enough. What they really need to do. I mean, I think there's an expectation that the authorities need to mail checks like they did in the US, and that fails to understand how Chinese psyches work. If you mail your average Chinese citizen a check, he's going to save it, right? The savings rate in China is off the charts. If you want to encourage Chinese consumers to consume, you need to do it very differently. Part of the measures that were announced at the weekend were around childcare and elderly care, ultimately building the fabric of a social safety net. Now, the reason people save so much in China is because there's very little by way of a social safety net. So, you are insuring against healthcare costs. You're insuring. Ultimately, you are saving frantically to ensure that your children have the best possible education that you can afford. So it's that when you want to stimulate consumption, you need to focus on removing the need to insure elsewhere. If that makes sense.
Yeah, and those are fundamental changes. Those are really big changes if they are able to execute on them.
Absolutely. Well, I mean, it's now 2025, and 10 years ago, China announced the Made in China 2025 industrial policy, much ridiculed at the time. You go through a checklist of what they said they were going to do and what they've actually managed to do. I mean, they've crossed off about 90% of the items. So when they make big announcements like this around consumption stimulus, I think you can bet it's going to happen. But in general, my approach to China, because of this sort of hot money effect, my approach to Chinese equities has been to try and stay away from the obvious chinternet names that are the US listed ADR names, the Alibabas as well, simply because you can get buffeted around by the hot money flows in those names. And I'm naturally drawn to sort of lower beta plays that don't exhibit the same kind of volatility and allow me to stay in trades for much longer, and not constantly crashing into stops.
Yeah, which makes sense, because we know that that there's only a few usually that, and they're heavily concentrated, that people are playing in. Do you we some of the some of the ETFs and the China indexes up like 20%. It's been a really big move. Do you feel like a lot of the good news is already priced in, or is there still a lot of opportunity?
Well, going back to how we started, I mean, these markets, even after the move, you just need to zoom out. The move, feels like a lot very quickly, but it's we've still got a long way to do to claw back some of the outperformance of the last several years, and valuations are getting cheap. We're now seeing earnings estimates being revised upwards constantly with these Chinese names. I mean, equity analysts are human beings, right? They need to react to the move in price, and so we're going to see upward EPS revisions. I wrote about the beverage companies in China last weekend. if you look at the Chinese beer market, so the total market cap of the Chinese beer companies, and China is the largest consumer of beer on the planet. The total market cap for the Chinese beer stocks is 41% of Anheuser-Busch, of the king of beers. Sorry,
your dog wants some beer. He heard beer and just started barking.
He's livid about the valuation of these beers.
After my own heart.
So 41% of Anheuser-Busch for the entire Chinese beer market, and if you look at that market cap of Chinese beer companies, that 30% of that 41%, right, is Budweiser Asia Pacific, which is 87% owned by Budweiser. So it's a massive market represented by tiny market cap right now.
Yeah.
And I also wrote about the Baijiu market at the same time. Now that's an 800-pound gorilla versus the beer market. So it's, that's at $480 billion of market cap. Full of names that you will have never heard of. But these are businesses that have 50 to 70% EBITDA margins and are not valued expensively. And collectively, the spirits business in China has $55 billion of cash sitting on their balance sheet right now. And right now, the sector's only yielding 3%. On a dividend basis. There's been a lot of noises being made about capital allocation discipline by the Chinese regulators. I think that a combination of upward earnings revision, some increased buyback activity, I think you could see a major re-rating in these names right now.
Wow. It feels like such an appropriate conversation to be having on St. Patrick's Day. So Ralph is asking, so you like Chinese consumer discretionary? Would you extend it to there, or are you very sort of like drilling down on certain aspects of the market that you find attractive?
Well, I've drifted into staples a bit with the beverages. I wrote about the consumer discretionary names earlier. It was a mixture of restaurants, retailers, and so white goods manufacturers that I wrote about a month ago in February. Actually, it was about a month ago, and it's a similar theme. I mean, I'm creeping into staples with the beverages, but I think that actually I can see a path where I start to write about some of the sort of the more sort of dull GDP linked businesses. I mean, if you look at some of the infrastructure plays in China, they're phenomenally cheap right now. The mobile companies. I mean, some of the industries need to be a little bit careful with, because not everyone can invest in them. If they're deemed to be connected with the defense industry in China. But I can see myself picking my way through the sectors over the course of 2025.
Well, we look forward to reading about it in your Substack, and we'll link Rupert's Substack when we post about it in Substack. So make sure you're connected with us both there. So are you, obviously you've got knowledge and you're using that opportunity to really, pick some of these, identify some of these opportunities. What about Europe and Canada? So it's interesting it's developed, right? Because I guess that's the easiest if you're going to shift allocations, because there's more established, I guess, bigger names, presumably more liquid names. How are you feeling about both of those regions versus the opportunities you're seeing in Asia?
Listen, I'm very overweight Europe as well. I put a big allocation into the European defense stocks immediately after the US election last year. That's done incredibly well. In fact, it's a trade that's terrifying me right now. I'm a scaredy cat when it comes to momentum trades, and these European defense stocks are giving me vertigo right now. But I know that if I sell them, I'll really struggle to get back into them. It's one of those thorny dilemmas. I like the European banks. They're working incredibly well. In fact, they're looking like Nvidia in 2023 European banks right now, and they've got plenty of runway.
And presumably, if they're going to, do you think they're going to be able to?
Ultimately, you need to be looking where governments are spending money right now. And we can all talk about the amazingness of US technology companies that justified the bull run of the last several years. If you were cynical, you could say that it was just that America was running larger deficits than the rest of the world, because they've got the dollar as the global reserve currency. They can afford to run a bit more fast and loose on the fiscal. But who's spending the money now, right? Germany's giving up its debt brake, maybe, if it gets everything that gets approved. Politicians in Europe are realizing that they've got to pump the stimulus. Your northern neighbors are pretty nervous about all this 51st state stuff, and they are going to be spending money like it's going out of fashion to ensure that they're never put into a similar position again. And it looks like there's universal support for that. And you know what? Where governments are spending money, equity markets tend to do pretty well.
That's we've seen.
and you're seeing the same in Japan, right? And you're obviously seeing the same in China. Everybody's spending money except for Scott Bessent right now.
Yeah. And he keeps saying, this is needed, and what's on the other side is worth it. It just depends on the time frame. So with all of this,
listen, on that, I think people need to be very careful. On that theme of it'll be better on the other side. I do believe that the US economy is so financialized that if you do kill the golden goose, right? What if you turn the key and that engine doesn't start again, right? And you've got to change the whole psyche of how CEOs are compensated, how they run their businesses, to suit their RSU plans. And if you break that whole set of crockery, you need to be very confident that you can put it back together again.
Yeah, and that is an unknown. I think that's I just had this conversation.
I'm not saying they can't, and I'm not saying necessarily it's wrong to fix the deficit, but you better have a pretty clear plan. And they appear to be changing their plan every single day, and that creates massive uncertainty, and markets loathe the uncertainty.
Right. And something came up in my conversation with Cuppy, and I was talking to someone over the weekend, having gone through several airports, and talking about air traffic controllers and, all of the sort of jobs they're trying to kind of refocus on. And everyone says they have a plan, but to revive the middle class, right? To revive that segment of the economy, bring manufacturing back. No one's asked the voters if they want to be middle class anymore, because we're kind of in this environment where everybody wants to 10x everything. And I think that's an open psychological question that we haven't looked at, and it's actually got me really concerned.
I find it incredibly patronizing, right? When people talk about, we're doing this for the middle. Out of the mouths of billionaires, that sounds remarkably patronizing.
Exactly, and I'm not sure it's going to land, the way that it's intended to. And I think that is that's a risk that hasn't really.
The whole thing about the American dream was that everyone was a temporarily inconvenienced billionaire, right? And the celebration of the steel worker and that steel worker was a temporarily inconvenienced billionaire too, right?
Yeah. And also, all of that happens without anyone seeing what was out there. Now we all see.
You mess with hyperfinancialization at your peril. I'm not saying it's a great. I'm not saying it's a great status quo, but you've got to have a really clear plan about what you're replacing it with.
Yeah, that's a really, really good point. If the U.S. does, if this attempt to transition to something else kind of creates a cascading decline in the equity market, let's say, Does the rest of the world do okay if the US markets start to really unravel? Is that a systemic, is the US too big to fail?
I think if we see a sort of a massive cascade collapse in markets, it's going to be very tough for other risk assets to perform. They may outperform on a relative basis, but you can't eat relative performance, sadly.
Yeah.
And yeah, I think if it really melts down, now the question is, what's the real pain threshold in US equity markets for this administration? What if the weakness in equities leaks into credit markets? What if that plunges up right now? This fighting talk about we're not looking at the equity market at all has a sell-by date, in my view, or a pain point, to put it another way. I don't buy that there is no pain point.
Yeah.
For all the reasons that we just talked about in terms of financialization, right?
Yeah.
So CEOs have already stopped making decisions right now because they're staring up. They're staring down the barrel of missing targets on their RSU award.
Yeah. So, Ched just said Fed rates still high, QE still not started. We have lots of ammo.
Yeah, and they're saying they don't want to use it right now. Right now. I mean, one of the larger positions in my book is at the front end of the SOFR curve, right? I think they're going to blink at some stage in the next 3 to 4 months, and I think the asymmetric setup in the very front end of the interest rate curve is really interesting. They're certainly not going to hike, so you risk a couple of basis points to potentially make 50 with an emergency cut.
Yeah. Interesting times. Rupert, this has been such a phenomenal conversation, and I think you really helped put some things into perspective beyond this, this sort of headline talk about reallocation.
Headlines are exhausting at the moment. You stay well away from those.
It's really, really great stuff, really. And you were so early to be pointing out the China trade, kind of banging your fist on that and writing such good substacks on it. And that has certainly worked out. So we appreciate you. We appreciate this deep thinking so early in the morning. You're amazing.
Thanks, Maggie. Great fun.
Great stuff. Thanks you all. Thanks in the chat. Some people have some St. Patrick's Day plans, but it's a kind of a bummer when it's on a Monday, right? Because we had a little poll. What are you drinking if you celebrate? And some of you put Guinness, but a huge majority said no alcohol for me. Hardworking investors.
Sober Paddy's Day for Maggie's
Paddy's Day has to happen. I'm in that camp too. So there's work to be done. Anyway, thanks everybody. It was great to see you, Rupert. Thank you so much. Love being with you, and we'll see you again soon.
Thanks, Maggie.
Thanks. Take care. Good luck out there, everybody.